Hello, and welcome to our market alert video for today, which is September 1, 2023. And hope you guys are all doing well. I am Ken Moraif. I'm founder and CEO of Retirement Planners of America. And I'm glad you're watching this video. Thank you. First of all, want to go over with you. Well, before we dive into it, got to give you a quick update. I'm kind of learning, as you guys may know, I have a 2-year-old grandson. He just turned 2 actually today. And I'm learning from him the power of doing this, because he does that. And then every adult in the room is like, what do you want? What do you want? Apple? Do you want juice? You want more cake? You want this? You want that? And he goes, and he learns how to talk now. So he goes, no, 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 no. And everybody's like, oh my gosh, what is he? And he's just pointing. So I've decided that that's like the most powerful thing in the universe. You just got to have the ability to point and the ability to say no. And then everybody jumps to attention. So I'm going to try this with my wife. I'll keep you posted on how well that goes. Anyway, let's talk about more importantly what's going on with the market and what's going on with the Fed and inflation and all that good stuff. So this morning we got the data on the jobs, and the jobs look like it's starting to slow down a little bit, which is what the Fed wants. So this is kind of one of those things where bad news is actually good news. And so now the talk is that maybe the Fed won't raise interest rates here in a couple of weeks when they come out with their big announcement. Now, of course, we haven't gotten the inflation numbers yet. We'll get those soon, and they'll have all of that and make their decision. But it is exactly what we have been saying is going to happen throughout this year when people were, we think, over optimistically saying that, the Fed is done with raising interest rates. In fact, they're going to start lowering them in the second half of this year, and that, mission accomplished. And what we've been saying is no, 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 not so fast, that inflation is not under control yet. And in fact, the Fed probably won't be lowering interest rates until April of next year. And now it's looking more and more like that's going to be the case. So right now, it appears that the Fed will probably leave interest rates where they are in September, not raise them or lower them. So why is all of this important? Well, because the Federal Reserve is responsible, in our view, for almost every major economic damage that has happened and the bear market that follows along with that. In 2008, you could make the argument the Fed did that, the Great Depression. So they are an important player, and we need to watch what they're doing. And if they raise interest rates too high, too fast, they can create a lot of damage with that. And if they do, that could create a very terrible recession and, of course, a bear market along with it, which is what hurts us as investors and as retirement planners. So that's why we want to watch the big gorilla in the room. And so right now, the interest rate hikes that they have made this year have been the fastest and the highest percentage change in history. And you must always remember that the effect of the rise of interest rates, it takes a year to filter through the economy. And so most of the rates that they have made, rate increases they've made so far, are not a year old yet. So we haven't seen the full effect of all this that they've done. We're starting to see it, the unemployment numbers, the wage numbers. We're starting to see that. What we hope is that it doesn't turn into something terrible, that it doesn't escalate, feed on itself, and all of a sudden we realize, oh no, they did too much. So that's the fear. Now, we don't think that's going to be the case. We do think that the economy is relatively strong, wages are holding, jobs are holding. And because of that, we don't think we're going to have a terrible recession and a big bad bear market. But of course, we could be wrong. So this year, our forecast was that inflation would bottom in June, and it did. We said it would start trending back up towards 4%, and it did start last month to go back up again. And we think in a few days here, we're going to get new inflation numbers, which will continue to show inflation is going back up again. And therefore, we think that, and we did say there would be a correction because of that, 5 to 10%. And we saw a 6%er. So we were pretty accurate about that. Our view now is that because the Fed probably will hold and that inflation will slowly start to come down, or the trend will look like it's going to come down into next year. That therefore means that we think the market will be higher at the end of this year than it is now. So inflation will continue to rise. The market will absorb that, digest it. We had our correction, and we think the end of this year will be higher than it is today. Inflation will start to come down next year, and the anticipation of that is what is going to drive the market this year. So if that didn't make any sense to you, it didn't make any sense to me either. But that's what I stick by what I just said. So what does that mean? It means that we could be wrong, and therefore it is very important to always have a sell strategy, a protection strategy, and of course we do. Our strategy, we call it invest and protect. And that's what told us to sell back in November of 2007 before the 2008 market crash. And of course, in April of last year, we got out of stocks, and also we got out of bonds. We continue to be out of bonds because as the Fed raises interest rates or leaves them high, bonds in our view are not a good place. And bonds have lost money this year for the most part, and they certainly did last year. So we don't think we're going to be buying back into our bond portfolio until probably April of next year. So kind of a mixed bag, but overall, we think that things are playing out the way we anticipated, and our outlook for the rest of this year in stocks is positive and bonds is negative. So now, if you are over 50, if you are retired or retiring soon, then one of the things we want you to be is a squipper. And you may wonder, well, what on earth is a squipper? Well, a squipper is a client of ours who is now enjoying their second childhood without parental supervision. They have retired, and squipper is the acronym for second childhood without parental supervision. We want that for you. And the only way we can do it is if you reach out to us. So if you go to our website, it's rpoa.com. The link is below this video. Visit with one of our retirement planners. We will build for you a retirement cash flow plan. We'll build for you a retirement plan. We'll work together to do it. If we can help you, great. And if not, that's fine too. Okay. So either way, there's no charge, there's no obligation, and we will part friends. So what have you got to lose? So thank you for watching this video. Share it with your friends. Subscribe to it. We'd love to have to help as many people as we possibly can. So thank you for watching, and we'll talk soon.